Does that deal, at least in principle, assuming the president sign it, does that give us maybe a little bit of an all clear to buy some stocks here?
Well, I think it sets up what today is more like a relief rally. I think there's a sigh of relief that maybe the vitriol in Washington doesn't lead and take away from anything that can be substantive or positive for the markets. Look, anything that reduces political uncertainty, anything that doesn't focus on global unrest or trade wars, that's good for the market. Because right now, as long as investors can look at decent corporate growth, economic growth, the corporate earnings economic growth, we have low unemployment, high wages, low inflation, oil's in a sweet spot. When the market can focus on those variables, it tends to stay in a positive range. When we're looking at trade wars and a hard Brexit, French riots, Italian banks, Venezuela, when we look at things outside of the core U.S. economy, that's when this market struggles.
You know, we're going to talk more about Venezuela in just a few minutes, but I want to talk about the other two things that you just referenced, Mark, which is this. Okay, we had, let's call it three things. Okay, we had, potential of another shutdown, Brexit, and of course the trade talks. So, yeah, maybe the shutdown one is gone, but you still have the other two big ones hanging out there. If we can get those resolved, we make a trade deal. There is no hard Brexit. They make some deal there too. Then what do you think happens to global equities?
Well, I think it creates a foundation for, and to avoid the fear out there. Right now, everybody, the ghosts of 2008 are on every investor's mind. When they talk to me, the baby boomers facing retirement, they're worried about the market crashing. So anything that offers an element of stability and then allows the economics to run the story is a net positive for stocks. I think China is a little more substantive. I think if we get a trade deal, that could actually trickle down to strong U.S. corporate earnings. It could help overseas companies. It will lower tariffs, lower costs. So that has a little more meat to it. But generally, it's anything that assuages investors' fears and concerns about a wider scale global lack of leadership. That's going to be good for markets.
Well, it's not as if we get this deal that we're entering some new era of bipartisan love, Mark. Right. I mean, you live and work in the city that we're talking about. 1.38 or whatever it is, $1.83 billion for this barrier and a couple of other deals. I mean, does that give you any longer-term optimism? Or is this just a one-off because both sides were annoyed by the outcome of the last one?
Well, I think it's more of the latter. If you think the Starks and the Lannisters are going to get along well, then you might think that Pelosi and Trump are going to get along well. This is a cage match. This is not going to go well. There is no way the Democrats want to give the president any victories. Infrastructure is more of a pipe dream at this point. Anything substantial is not going to happen. Anything that stimulates this economy out of Washington is not going to be passed because, look, everybody's announcing for president right now. It's game on. Today is more of a relief. It's, well, okay, we can avoid disaster in Washington. And for now, that's good enough for some stock investors, and it's good enough to send these markets a bit higher for now.
Yeah, and we've had this great January and a pretty good February. And, listen, people are getting back, not all, but a lot of what they lost in December. Assuming they didn't sell, they're coming back. If you timed it, work, congratulations. But when I look at the bond market, Mark, and I don't like to look at it because it's so slow moving, but I see 2.65% on a 10-year. I wonder what that's telling us.
Well, it's telling us the 3.25 we had last year is far away at this point. It points to a little bit of that global slowdown we're talking about. But it also, for retail investors, creates an opportunity for them to invest in an alternative to stock. We used to have TINA. There is no alternative. Now you have two alternatives. You have a bond market with decent yields, and you have CD rates. And investors who are approaching retirement, who are a little nervous, who are skittish, who are worried about these headlines, the daily tweets, the overseas news, they have another alternative. And when cash competes with stocks and when bonds look attractive, that creates a headwind for equities. And that's what we might see later this year if things don't tone down and we get a more normalized news cycle. People might just say, enough is enough. I want to sit this one out. It's too nerve-wracking for me. And I'm telling you, that's kind of the conversations I'm hearing from investors.
Good stuff.